So in discounting of cash flows, we are moving forward and we are actually moving now towards investment for 2 years. And if we invest in stock of a company for 2 years, definitely there will be, if we assume that this company is paying dividends, then we will get two dividends, right? Although we know that payment of dividend by company is not compulsory, right? Interest coupon payments on bonds have to be paid. They are compulsory payments. So whether company makes a profit or not, company has to pay interest or coupon payments to the bond holders. That is compulsory payment. But dividends on shares are not compulsory payments. But here in this model, we are assuming that there will be perpetual dividends that this company is paying. So first dividend would be discounted at required rate of return for 1 year. So this is definitely 1, but we don't write 1, so it is assumed. Second dividend would be discounted at required rate of return for 2 years, so that would be 1 plus r whole exponent 2, and eventually after 2 years we will sell the share. So price after 2 years, which some analyst might have projected, we get to know that price and we discount that price at the required rate of return, and this discounting happens for 2 years, because this is the price that would be realized after 2 years. So this is the value at zero. Value at zero means that today this is the intrinsic value of this share if we hold this share for 2 years. But the same formula can be now generalized for n number of years. And since we are discounting the dividends, so this discounting of cash flow is actually known as a dividend discount model. Sometimes we call it DDM, but its full form is dividend discount model. So we can generalize it for n number of years. So intrinsic value today would be discounting of all the dividends for all the n years plus the terminal value at the end of nth year. So when this discounting is done, and then this is a generalized dividend discount model. But rather than conceptually talking about them, let us do one question here. So we are moving into scenario of investment for 2 years. So let us assume that there is a stock which is maybe any company XYZ Limited. This is fictitious company. Its share is currently trading at $35, and analyst predicts that the price of this share would be $48 in 2 years. And this company is steady on paying dividends, so dividend it would pay after 1 year is $2, and after 2 years it would pay a dividend of $3, and the required rate of return is 10%. So if this is the situation, then what we are doing, in order to calculate the intrinsic value of this share, basically what we have to do, we have to discount the dividend after 1 year for 1 year, and discount the dividend that would be received after 2 years for 2 years at a required rate of return. Then after the 2 years we will also receive the price by selling this share, which is also known as terminal value, and that would be discounted at a required rate of return for 2 years. So these are the calculations we have to do. So first year dividend would be discounted at 1 plus 10% for 1 year. $3 would be discounted at 1 plus 10% for 2 years. After 2 years, definitely this would be sold at $48. So this would be discounted at 10% or 0.10 for 2 years. This is 0.10, so you can write 0.10, 10%. So this is intrinsic value of the share today. We can also call it V0 if we like. Now, in order to discount these, what we will do, we will first of all discount this number at 1.10 exponent 1 here, and 3 plus 48 is 51. $51 is divided by 1.10 exponent 2. So rather than doing this little discounting, we will use TVM row, second clear TVM. Now here 51 is to be discounted for 2 years. So 51 is future value, 10 is IY, 2 is N, compute present value. So this is discounted. This cash flow when discounted today comes out to be $42.15, and then we also discount the $2. This is discounted, $2 is discounted, 2 divided by 1.1. It gives us 1.182. So we add to that $42.15. So the value of this share is $43.97.